Hey, good morning and welcome from the Price Group. My name is Matt Price, and we are excited you are here. Today we'll be talking about the retirement planning timeline. So something I've been told I'm not allowed to talk about any longer at the dinner table, but might not be the most interesting topic. We do think it is very important and helpful for those of you that are on the verge of retiring or possibly in the first few years of retirement. So a little bit about us. That is Randy. He tried to tell you he's my older brother. He is actually my father. We have a retirement niche. Over 80% of our clients are retired. We follow a fiduciary standard, 45 plus years of experience between the two of us, and family owned and operated. We have a team of 5 people supporting us, and they really are the backbone to our operations. Been humbled to be recognized by Barron's. Randy actually was recognized last week by Forbes as a top best in Texas state advisor, Financial Times. We're both CFPs, certified financial planners. We both went to the Wharton School of Business to obtain our CIMA, certified investment management analyst designation. And if you've been following along with any of our emails, you probably are familiar with the Wealth Coach podcast. We put out blogs and our weekly market commentary each and every week. So a little bit about our firm for those of you that may not be as familiar. Steward Partners, based off the biblical definition of stewardship, 30 plus offices across the country, not owned by a bank. We think that's very important. Our custodians, all our clients currently use Raymond James as their custodial option, which means where their assets are held. We also have access to Pershing and Goldman Sachs, and possibly a few more to be announced later this year. But Raymond James has been a great partner, and we've really enjoyed working with them. So today, our agenda, we're going to be talking about 2 to 5 years from retirement, less than 1 year out from retirement, and then what does planning look like after retirement. So let's start with the 2 through 5 years. We say, let's look before you leave. And what that means is we think you need to have a written plan, a wealth management plan for your retirement. We would argue that if you don't have a plan that's written down, you don't have a plan at all. People usually have a plan up here, but a lot of times when you start writing things down, it doesn't necessarily translate to what you've thought about throughout the years. So we call our plan a Live Well plan. We'll talk about that in a little more detail. In this Live Well plan, we develop what we call our family index number. What rate of return does your family need to be successful to and through retirement? So this is not a cookie cutter number. This is something peculiar to each family, based on your goals, your objectives, your risk tolerance, et cetera. With that, how much should we contribute? Should we be doing pre-tax 401ks, Roth 401ks, retiring the middle of the year versus the end of the year based on when some bonuses might pay out is a big thing looking a few years out. And then we'll talk more about this. Consider the consequences of a negative year in the stock market. If the market did have a 10, 15, 20% pullback, would that affect when you could retire? And so having your portfolio aligned with how you want it invested in retirement is typically something we start to do 2 to 5 years out. And we think this is the perfect time to consider hiring a qualified advisor who does specialize in retirement. So kind of in that same time frame, 2 to 5 years, we think a consideration, we're asking the question, is your spreadsheet adequate for retirement? And our simple answer would be a spreadsheet works really well while you're still working. We would argue that a spreadsheet is woefully inadequate in retirement. And this is a simple example to illustrate a point. Let me look at the 4 boxes here. The 2 boxes on the left are in the accumulation phase, or while you're still working. We're starting in this hypothetical example with $100,000, and while you're still working, you get a bad return in year 1, 7% rate of return from years 2 through 9, and a good return, 29% in year 10. You start with 100,000, you end with 188,000 and change. Now, let's take the same returns and flip them in the opposite order, once again, while we're still working. So you get that good return in the first year, sevens in year 2 through 9, and a bad year in the 10th year at negative 15%. Down to the penny, you end up with the same dollar amount, 188,000 and change. However, there's a stark contrast in the accumulation phase when we compare it to the retirement or the distribution phase. So now let's draw our attention to the two boxes on the right. You have that bad return, negative 15% in year 1 in retirement when you're taking $10,000 out per year from this portfolio. And you can see you run out of money somewhere between years 9 and 10. Not good. However, you get the same returns over the 10-year period, but you start with a positive rate of return and end with the negative. You end your 10th year with over $52,000 left. So what this is illustrating is the sequence of returns doesn't really matter before retirement. However, it is very important in retirement. And because of that, that's why we say a spreadsheet might not be adequate to say we're getting a static, pick a number, 3, 4, 5% rate of return in retirement, because that's not really how the world works. And if it was, it'd be much easier to plan for and walk through retirement. So because of this, we are convinced you need more than just an investment guy. You need a wealth coach. This doesn't matter if you have $1 million or $15 million. Our experience has been that people are asking the same questions regardless of your net worth. So what we think that means is a holistic financial plan that includes retirement, tax planning, estate planning, cash flow planning, insurance, investments. I love this quote by Benjamin Graham, who is one of Warren Buffett's mentors. The best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline, that's key, to get you to where you want to go. And we believe in that wholeheartedly. Every year, Vanguard publishes a study on the value of a financial advisor, and it usually comes in right around 3% per year of the value add based on the different services that advisors do provide. So that begs the question, what should a retirement plan include? And we think retirement, it's not an event, it's an ongoing process. So we said earlier, we don't think it's a plan unless it's written down, but we think any retirement plan should include the following. And this is what our Live Well plan does attempt to answer for each family that we do this for. How much can you spend in retirement? How long will your money last? What rate of return do you need? And how do you invest your portfolio for increasing income to combat inflation and to protect your principal? A lot of clients or people who are kicking the tires will say, hey, you know what? I know that I have enough money to last for my lifetime, but my goal is, how do we build a legacy? How do we make sure that we have a certain dollar amount available for my kids, for my grandkids, for a charity of choice after I have passed? And so we're not always solving for just to have enough money left. We're solving for a family to be able to pass wealth on to the next generation in the most efficient manner possible. And once you start having that conversation, one, I think it becomes more fun for the family and selfishly for us, but two, that's where the planning becomes a little more complicated, a little more complex, and there's more, I'd say, arrows in your quiver at that point to do some real creative planning to optimize the family's inheritance down the road, to avoid taxes, et cetera. So we briefly mentioned a family index number. Once again, this is the rate of return that we think you need to be successful. And unless you would tell us otherwise, we're trying to solve for the least amount of risk to get you from here to there. So not a cookie cutter number. This is peculiar to each family. Some of the feedback we've gotten from doing some of these webinars, they said, hey, could you just give some tangible ideas for us, for people that are approaching retirement or possibly the first few years of retirement? So here's one tangible idea we have for your consideration. It's an alternative to the Roth IRA contribution. And you can put money into a Roth only up to a certain income threshold. So a lot of people we talk to have been phased out of adding money to a Roth IRA. So this could be considered a backdoor Roth IRA. But what you do is you put money into a non-deductible IRA, meaning it's not an itemized deduction on your tax return. And then you convert that the very next day into a Roth IRA. So say you put in $6,000 on a Monday, you convert it to on Tuesday, you would owe taxes if there was any gain, but since it's only been in there for a day, there's obviously no gain in that. The place where you could stub your toe is what we call the pro rata rule. So this does not make sense for someone that has any other pre-tax IRA dollars. There's a salient difference here, though, with IRA dollars versus 401k dollars. So IRA dollars, it does not work. 401k dollars, it can work. Something to run by your tax professional, but this is a great strategy for you and also possibly your spouse to add money to a Roth, even if you've been phased out of the income limitations. And our second idea, I'd say it's the first cousin to what we just talked about. This is another way to add some money into the 401k. So this would be for those of you that are still working. Not all 401ks allow this. So it's contingent upon the actual plan documents within there on if they do this or not. But you can max out a little over $20,000 per year if you're under the age of 50. And you can add another $5,000, $6,000 on top of that if you're above 50. In addition to that, some plans will allow you to add after-tax contributions to your plan. And that limit is typically lower in the $13,000, $14,000, $15,000 range. Most plans that allow for an after-tax contribution in addition to the pre-tax or the Roth allow you to do a conversion once a year to take those after-tax contributions and roll them into a Roth. Once again, no tax ramification with that. So great way to supercharge the Roth 401k, which ultimately can transition into a Roth IRA whenever you depart the company, do retire, or just want to start taking some money out of the Roth 401k. So I'd say possibly granular details or ideas there for your consideration. We're happy to discuss this in more detail, see if it makes sense for your personal situation. We also think 2 to 5 years from retirement, you should evaluate your risk budget. Here's a great example in this image here. The purple line represents the S&P 500 from 2000 through 2015. And the green line is taking 50% of the upside, but also 50% of the downside. And what you can see is over this 15-year period, you actually end up better off taking 50% of the risk out of the portfolio. So no one knows for sure what the next 15 years will hold. With that being said, our point is kind of the question we posed: would a 25% correction delay your retirement? And we think the planning, our Live Well plan, is vitally important to help you answer that all-important question. And then the last thing, 2 to 5 years from retirement, we do think this is the perfect time to consider hiring an advisor. You can see this study here on the right, which is done pretty much every year by JP Morgan. The average investor has woefully underperformed stocks, bonds, and actually just the value of their homestead over a 20-year period. So we think advisors do add value. We don't think looking at the cost by itself is necessarily the best way to do it. What value do you get net of the cost? And a good question to ask advisors that you have hired or are looking to hire: tell me about your client retention rate. And why we think that's a good question to ask is that essentially answers the question: do clients think that you're adding value to the point where they're not leaving? So that's a great question. If you are kicking the tires with a couple of teams, a couple of advisors, that helps you get to the point. Are you essentially adding value on a regular and consistent basis for your clients to which they don't want to leave? But advisors, there are studies done, reduce stress and more access to some alternative investments, individual bonds, and strategies for additional income. So we are a little bit biased, but we do think we have added and can add value for families moving forward. So let's switch our attention to retirement planning less than 1 year out. The sun is setting, you are close to retirement, and it is coming up closely if you do fall into this category. So we really want to focus here on estimating your retirement expenses. We never want to use the B word, a budget, but we do want to make sure that the spending assumptions that we've used within your Live Well plan, that they are good. We always want to have a good fudge factor built in there. We want to make sure we've include healthcare costs. If you're retiring before 65, what does private insurance look like? And then we want to plan for some unknowns. If you don't have long-term care insurance, we want to factor in some potential long-term care needs down the road, because that can be a real curveball for families if they are not financially prepared for that. Pension versus lump sum, we'll start having conversations about the discount rate. What are interest rates doing? This could be arguably one of the bigger financial decisions that you make in your life, which one is best for your family. We have quite a few spreadsheets and educational tools to help you make that decision. There's not really a one size fit all. It depends on each family's peculiar situation. Are you under 59 and a half versus over 59 and a half? There's a few planning tools that are peculiar to that magical 59 and a half age, where if you're retiring before, ways to access your funds without incurring that 10% penalty. Not as important if you're above 59 and a half. But how are you going to produce income? This is a key question that we need to make sure that all parties are comfortable with, but retirement really is an income-driven exercise. And we think rule number 1 in retirement is produce income. Rule number 2 is do not forget rule number 1. So I mentioned the discount rate and tax rates. Are there any changes that could be made? And then if you haven't hired an advisor, we think it's better to do it on the front end of retirement versus doing it at or after retirement. Income needs in retirement, the rule of thumb is 70-80% of your final year's salary. Inflation in retirement, we think it's really a hidden tax. So we factor this into clients' Live Well plan. We need to make sure you're factoring this into your retirement as well. Randy likes to joke. He says the bank of mom and dad is always open. I have 3 young children with our 4th on the way, and I can attest that I do agree with his statement. Big travel items, we want to include travel into your income needs, ongoing fixed and variable expenses, for depending where you live, part or all of your property tax get frozen at 65, which takes a variable, moves it to a fixed, but we want to make sure we're adjusting those variable expenses if and when necessary. And then gifts to charity. A lot of our clients are super generous, not only with their money, but also their time, whether that's gifts to family, gifts to charity. And what do those gifts look like year over year moving forward? We want to plan for that as well. So it's a lot more than how much money do I need to spend. We want to try to create this picture that includes not only what you need, but also what you want and what you desire. So a good question is 3% the new 4%. A lot of you might be familiar with the old, what we call the 4% rule. That was a study done. You could take out 4% from your portfolio, get a raise on a regular and consistent basis, own a balanced portfolio, part stock, part bond, and have a high degree of confidence that you will not run out of money over your retirement. However, that study was done over the 70s, the 80s, the 90s, the 2000s, where interest rates were a lot higher than they even were today. So one could make a fairly compelling argument and say 3% is the new 4%, even though interest rates have gone up quite a bit over the last 12 months. They're still low by historic measure. And so one could say taking 3% out from a portfolio is more prudent than taking 4%. Now, obviously, these rules of thumbs, they aren't something that you should really make decisions on your own. What we're essentially solving for with your family index number inside our Live Well plan is what rate can you take out from the portfolio with your situation to feel good about. Within 1 year from retirement, really start studying that company pension versus the lump sum. And there's pros and cons to both. So there's not really a one size fit all, but the lump sum makes sense if you think there is going to be inflation. You do want to do some family legacy planning where you want to leave money to the next generation. However, you can spend through the capital, spend too much, and not have enough money left. The pension is income for life, depending on if you take it 100% joint and survivor, which means your spouse gets the same amount for the rest of her life. It does limit some of your flexibilities, but overall, there are now some non-company annuity options actually that are equally, if not more compelling, that are matching up in some cases better than the company pension. So happy to talk about that as well if you're leaning toward the pension, see if there's a better option out there in the open market. For those of you who had a great meeting actually last week with a lady who will potentially be retiring before 59 and a half, and how do we get funds prior to that magical 59 and a half age? You can take a one-time distribution from your 401k when you're rolling it over to avoid that. You can do what's called 72T. This is part of the IRS code section 72T, where you can take the equal payments for the greater of 5 years or until you reach age 59 and a half. The catch there is those payments cannot change in amount. So if you started taking, pick a number, $3,000 per month, you would have to continue that payment until the greater of 5 years or until you reach age 59 and a half. Lines of credit are something that people will use. Having some vocational income, you might say, well, you know what, I'm only making $1,000 a month. It's really not going to move the needle. Making $1,000 a month, if you're retiring really early, it can have a material impact if you're finding something that you enjoy. We had a client who moved to Colorado and they loved to hike, and he became a part-time hiking guide. And his words, not making a lot of money, but it really has had a dramatic impact on his Live Well plan. And then obviously after-tax assets, you have accumulated after-tax assets as well. And if you haven't started to make changes to your portfolio, we think now is the time to do that, to align the portfolio with what we think your portfolio should look like in retirement. And as I said earlier, rule number 1 in retirement is produce income. Here's a look at dividends compared to the overall total return of the stock market dating back to the 1940s. And what you can see over this long period of time, dividends are approximately 40% of the total return of stock. So we think that's a real material number. And dividends are even more important in retirement than they are when you were planning for and moving towards retirement. So we think dividend stock should be your best friend the year leading up to retirement, creating a game plan that gets you where you want to be, but also in retirement to produce that needed income. And so what we get questions, well, what do we do with the non-stock piece of the portfolio? And this past year was a super interesting year for bond investors. It was one of the worst years on record dating back to 1976, worse than 2008 for high quality bonds. The overall bond market was down about 13 to 14%. So are bonds quote unquote safe? you see safe there in italics. We're big believers in building short-term bond ladders for clients, but also having some bond alternatives built into the portfolio. So we have a few different, I'd say, recipes that we use when looking at fixed income. And we think the old way of investing in bonds or fixed income, just buy some corporate bonds in mutual fund format, that's fine, but there are some more unique, peculiar, and arguably better strategies out there for people who are approaching retirement. So would love to discuss that with you more in detail. And then 1 year to retirement, we really need to define, what does your investment process look like? And I think a lot of people would say, oh, yeah, I have an investment process, but this is a look back from 1996 through the end of 2019. And what you see here in the little red rectangles, the blue are the net fund flows from stocks. And so when the market bottomed at the end of 2002, remember 2000, 2001, 2002, all negative years in the stock market, people finally threw their hands up and said, I've had it, I'm getting out. And you can see most people sold really at the bottom. Fast forward to end of 2008, early 2009, same thing happened. The market bottomed and everything went on sale, and you see people selling at the bottom. So this is a testament that most people do not have an investment process. And we can promise you this, that up until your retirement, possibly, but definitely during your retirement, markets are going to be choppy. Markets are going to have pullbacks. That's just the price we pay to grow capital within the stock market. We know it's going to happen. So having a process is really important before retirement, so we don't stub our toe, and in retirement, you really don't have time to make up for making some of those poor decisions during a market downturn. So having that investment process, how much can you spend in retirement? And then how do you invest the portfolio to meet income needs? So let's look at planning after retirement. For those of you that might be right at retirement or after, what does that look like? We think it's super important to stress test your portfolio on a regular and consistent basis. What that means is this. Let's use an example. Say you're taking 4% out of the portfolio and your portfolio is down 20%. One might say, well, I just need 20% to get back to break even. But you can see here with those metrics, you actually need your portfolio to have a 36% rate of return to get back to where you started. So the real way you win in retirement is by not losing. And what I mean by that is you need to have a more risk control budgets in place in retirement when compared to saving for retirement like you've done pretty much your whole life. So once again, a few planning ideas for consideration. These are not all inclusive. These are just a few ideas that we thought could spark a conversation, something that you could think a little bit more about. Holding assets that generate income in qualified accounts. We think that's important. Qualified charitable distributions, the acronym QCD. You can take a portion of your RMD up to $100,000 and give that directly to a charity. And that counts toward your RMD. However, it's not taxed. So this is the most tax efficient way to give money while you are, or it actually starts at 70.5 when you can do this, even though RMDs are moving to age 73 this year. Gifting of appreciated stock. We're doing this, if not weekly for clients, at least monthly. Giving stock away that's appreciated and then buying the stock back with cash to reset their cost basis. When to take distributions. People can say, well, I'll just wait till I have to. And that sometimes is the best strategy, but a lot of times we can lower the lifetime tax bill by taking smaller distributions from IRAs. And if you don't need the money, considering partial Roth contributions year over year to utilize some of the lower tax brackets. So with that being said, we're trying to benchmark not how are we doing against some arbitrary index, the S&P 500, the NASDAQ, the Dow, but how are we doing against our goals? Are we meeting our goals in retirement? So trains are running right on schedule here. Try to be 30, 35 minutes in our presentations. So we'd love to create a Live Well plan. For those of you that we haven't done it, a few of you we have. We're happy to revisit that Live Well plan and update some of the metrics for you. Randy, he likes to pretend he's an old Baptist pastor. He talks about comfort, confidence, and clarity as what our Live Well plan attempts to provide. And we're happy to do that for you on a complimentary, no strings attached basis. So from Randy, myself, that's Maddie, Tiffany, and Melissa as well. Thank you for your time. And we are here for any follow-up questions. Look forward to hearing from you soon. Thanks. Bye-bye.